Welcome to Market Newsroom. Here is your complete market briefing for August 8th. July's employment report showed the United States losing 23,000 jobs instead of gaining the 80,000 economists expected. The private sector added 30,000 positions, but local governments cut 57,000, pulling the total below zero. That surprise sharply reduced fears of a September Federal Reserve rate hike. Prediction markets placed the chance of rates remaining unchanged near 60 to 65%. Investors reacted quickly. Technology stocks helped equities rebound, bonds rallied, and yields moved lower. A bond yield is the return investors receive for holding debt. Yields generally fall when bond prices rise. Gold and silver also benefited as investors expected a friendlier interest rate environment. The key question is whether this report marks a lasting slowdown or one-week month. Investors should watch upcoming labor and inflation data because either could change the Fed's next decision. Group of senior bond dealers advising the United States Treasury has warned that current auction sizes could leave a $1.45 trillion funding gap in fiscal 2027 and 2028. The Treasury finances government operations by regularly selling bills, notes, and bonds to investors. The warning means the planned pace of those sales may not raise enough cash to cover expected borrowing needs. Closing the gap could require larger auctions, stronger revenue growth, spending reductions, or some combination. For bond investors, greater debt supply creates a risk that yields must rise to attract enough buyers. Higher long-term yields can also increase financing costs for real estate, infrastructure, and businesses competing for capital. This is a longer-term warning, not a claim that funding has already failed. Investors should monitor Treasury auction results for weak demand and watch whether future issuance plans expand. Energy affordability is becoming a major political issue as households face rising electricity and gas costs. United States residential electricity prices increased 7% in 2025, with double-digit gains in more than a dozen states and Washington, D.C. Voters are connecting higher bills to broader infrastructure pressures, including growing electricity demand from data centers. Candidates from both major parties are responding, with different explanations and solutions. Democrats have linked higher gasoline prices to foreign policy, while Republicans emphasize domestic production and deregulation. Across both sides, immediate affordability is receiving more attention than aggressive climate targets. That shift could support traditional energy producers if policymakers favor near-term supply and price relief over stricter environmental rules. Investors should watch campaign proposals, utility rate pressure, data center electricity demand, and whether future policies prioritize household costs, grid expansion, or emissions reductions. That is today's Daily Edition. Subscribe to Market Newsroom for market-moving news every weekday.